Hi guys, Ben here. Let's talk Tesla stock. Now it's been a while since I've spoke about Tesla and many of you guys have requested to know what is the true value of Tesla stock and is it still a buy in 2021? Well, in this video, I'm actually going to do a deep dive valuation into Tesla stock to find out Tesla's true value. Now, this is not just going to be some sort of opinion video, which many of these YouTubers do these days. They just say, Tesla's a buy, Tesla's a sell, Tesla's going to go to $5,000 per share, etc., etc., etc.
And buy the dip! Oh yeah, they love to buy when stocks are down, regardless of the news backdrop.
This is going to be a real deep dive calculation. I'm going to be using what's called a discounted cash flow calculation method, or DCF. It's going to be extremely interesting, and you guys are going to be so shocked by the fair value of Tesla stock, which I show you guys. So Tesla stock this year has increased by nearly 700%. So that's fantastic returns this year. So congratulations to those that invested along with myself in Tesla stock. Now, the classic phrase, the stock is too high and competition is coming, has been thrown around so much with Tesla stock, even by Elon Musk. Now, the interesting thing with this video is it's not going to be a real bull case on Tesla and it's not going to be a real bear case on Tesla. It's going to be a reality check for Tesla. What's the true value of this company using the numbers this company is projecting and also the numbers this company is producing right now. But before we dive into that, if you're new around here, why not consider joining the investing family by hitting that subscribe button and turning that notification bell on. And if you want to take things a step further, hit that first link in the description below to be taken to the Patreon page where you can check out the VIP membership group. There you can gain access to my buy and sell signals, so when I make my moves, you can make your moves, in addition to my entire investment portfolio. I'll also be using a spreadsheet in this video, and I'm going to include that in the VIP membership group for you guys to download and use freely to value companies. So with that being said, let's dive in. Okay, so firstly, let's level set. What is the value of a company? Now, you'll notice I always say company. I never really say stock too much because a stock is a portion of a company, and that's something we need to constantly reinforce and remember, because if you just think stocks all the time, you think stocks are some magical, mystical force, you'll forget about the fundamentals of the company.
Stocks only go up.
So the value of a company is the value today of the company's expected future cash flows. Now, Warren Buffett was actually asked how to value a company in one of his talks, so I'm going to let him take over now and explain it a little bit deeper. Go for it, Warren.
Is how do you find intrinsic value in a company?
Well, intrinsic value is what is the number that if you were all-knowing about the future and could predict all the cash that a business would give you between now and Judgment Day, discounted at the proper discount rate, that number is what the intrinsic value of a business is.
So Warren did a great explanation there, and he used the simple analogy of a bird in the hand is worth two in the bush. So if we have $100 today in our hand, that is worth more than $100 in 1 year's time. Partly due to inflation, partly due to the risk factor associated with getting that $100 in 1 year's time. Now, taking things real back to basics, the only reason we are investing is so we can get more money back in the future. That's it. So really, as investors, as stock analysts, we're trying to predict the future cash flows of the company. Now, for those of you in the VIP group, you'll know my full investing principles, investing strategy. And I tend to do what's called quantitative and qualitative analysis. Now, before those words confuse you guys, let me just explain it real simply. So quantitative is the numbers side of investing. That's the cash flows, revenues, the price to earnings multiple, price to sales multiple, etc. Then the qualitative side is the things we can't really touch and feel. These are the intangibles. This could be the brand. This could be the competitive advantage of the company. This could be the management. So in Tesla's case, there is a lot of qualitative factors in the company. And with qualitative factors, they're actually very hard to value. How can you put a price on great management such as Elon Musk or Jeff Bezos? How can we put a price on that person? It's very, very difficult to do. So that's why many value investors tend to just ignore growth stocks, but in doing that, they miss out on major opportunities. An alternative to just ignoring all growth stocks, which is basically almost every great stock in the past 10 years, is to actually try and translate the stories of the company into tangible numbers in order to estimate different probabilities to give us a fair value of the stock. So Tesla, some say it's an automaker, some say it's a technology company. The technology company is, of course, due to Tesla's Powerwalls, Tesla's solar roofs, and Tesla's autonomous vehicles, which are supposed to be coming in the future. However, let's look at today's values and facts. So 94% of Tesla's revenue today is from automotive sales. That's $19.6 billion. And energy revenue makes up just $1.2 billion of these sales. So from a valuation perspective, the other parts of Tesla's business only make up 6% of Tesla's revenue. Thus, we need to take this into account when we're doing our valuation. All it means is we need to add a greater risk to those parts of the business because they're unproven so far. Now, let's go through a few scenarios. What we're going to look at for Tesla is the best case, worst case, and average case. So firstly, let's get some more facts. So according to Deloitte, the forecasted global battery electric vehicle units sold in 2020 is 1.9 million. By 2030, that is expected to reach 25.3 million. This is an average growth rate of around 29%. Now that is incredibly high. So if an industry is growing at 29% per year, you could expect a market leader in that industry to also be growing at least 29% per year, which is fantastic considering the average return for the S&P 500 or the market is around 9 to 10%. Now, Tesla has currently sold around 500,000 vehicles. This represents 26.3% of total electric vehicles sold. So Tesla basically has a quarter of the market share, which is also fantastic. However, let's be more optimistic for our valuation. Let's say Tesla, with its various new models such as the Cybertruck and its mass market $30,000 model, can actually grow its market share to around 50% of all electric vehicles sold. So basically by 2030, every 1 in 2 electric vehicles sold will be a Tesla. Now that's a very optimistic scenario, but just follow me so far. Now this was the ironic thing about using this optimistic scenario. So at today's share price of approximately $700 per share, if we calculate the price to sales ratio for Tesla in 2030, this gives us a price to sales ratio in 2030 at today's share price. So if today's share price did not move, you invested today around $700 per share, the share price didn't move till 2030, that would still give you a price to sales of 0.85. Now to put that into perspective, let's compare it to some other companies. So Toyota, GM, Ford, yes, they are automakers. They all trade at a price to sales for next year of 0.54. So the idea of looking at this is basically to say, in 10 years' time, a lot can happen. There are a lot of risks. There's a lot of uncertainties, and Tesla will still be expensive at today's share price in 10 years' time. And that's with all those risks and uncertainties. Whereas the automakers, they're predicting just for next year, which is really minimal risk, they're predicting to have a better valuation than Tesla right now. Now, I know what you guys are going to say. You're going to say, Ben, Tesla is not an automotive company, it's a technology company. And I do agree, but we need to look at all different scenarios. So the worst case scenario is Tesla is an auto company, which is the realistic fundamental scenario right now. With Tesla's car sales making up 95% of their revenue, that's just the facts right now. But also another fact right now is Tesla's planning to become vertically integrated, and they've even purchased a lithium mine. Now, I actually did a video on this a few months back, and the lithium mine which Tesla purchased, I actually predicted that mine to be purchased by Tesla, and many of you guys made an absolute killing. So congratulations on all that. And if you appreciate updates like this, feel free to give the video a big thumbs up. Tesla also has the highest number of real-world driving miles for their autonomous vehicles. This is much greater than the likes of Waymo and many other players out there. So that's another plus for Tesla. So now I'm going to dive into my valuation model for Tesla, and we're going to go from there. So here's the valuation model I've created for Tesla. Now don't be alarmed by all the colors and numbers. Now I've actually done another video explaining step by step exactly how this valuation model works, so you guys can actually use it yourself. You can download it if you're in the VIP group. In investing, we need to look at different scenarios. We can't just assume best case all the time. We have to assume the best case, worst case, and average case. And basically, if the best case is, say, a 10x, and the worst case is a 20% drop, then that could be a fantastic investment. However, if the best case is only a double, and the worst case is a 80% drop, then that could be really, really risky. So let's dive into Tesla right now. So average case, this is what we're expecting. So Tesla's recently grown at a growth rate of 50% per year, which is fantastic. However, as companies tend to get larger, they do find it harder to continue that growth. Now, after the next 5 years, let's assume that growth rate decreases to around 40%, as the company will be so large then, it will be growing at a slower multiple, because that's just economics. Now, discount rate, this is basically my required rate of return. Now, you can use the US Treasury rate of return, but in this case, I'm just going to use 10%. I want 10% returns on my investment as a minimum. So that's what we're going to use for the discount rate. My other video will explain that a little bit deeper if you guys want more on that. Terminal multiple, so that's the price to earnings multiple on this stock, or the price to sales multiple on this stock. Now, currently, Tesla's price to earnings multiple is 183. Their price to sales is 23, and their price to free cash flow is 366. So these are incredibly high, incredibly optimistic numbers. Tesla is currently priced for perfection. But for our average case, let's assume a terminal multiple or price to earnings multiple of around 50. Now, the average for the S&P 500 is around 25. So 50 is still double the valuation of the S&P 500. So if Tesla can grow at 50% for the next 5 years, and in 5 to 10 years grow at 40% and trade at a price to earnings multiple of around 50, or a price to free cash flow of around 50, then we can expect a market cap of $1.1 trillion. So basically, as an estimate, for our average case, Tesla has one more double in it, at least. So that's the average case. From the factors I've introduced, we could probably double our money at least one more time on Tesla. But now let's look at the other cases to see what risks we're taking. So for the worst case, I'm going to assume Tesla's growth rate drops off from 50% to 25%, which is still a fantastic growth rate for many companies. And 25% is the growth rate predicted approximately for the electric vehicle market. So it's still very realistic, the numbers I'm using right here. So for the worst case, we're going to say Tesla over the next 5 years grows at a 25% growth rate. And then for the next 5 to 10 years, as Tesla grows in size, we say that rate drops to 15%. So let's say in this worst case scenario, Tesla's autonomous vehicles are still not fully developed. Let's say a few of them start crashing, that caused the company to have some really bad press. And let's say the Tesla Powerwall and Tesla Solar Roofs don't really grow that much from where they are and still only make up around 6% of Tesla's revenue. Then for this worst case scenario, which is still quite a realistic scenario, we add a terminal multiple, price to earnings multiple of 25. Now that is the same as the S&P 500, so that's also very realistic. In that case, Tesla's market cap will drop to, wait for it, drum roll, $100 billion. Now, to put that in perspective, Tesla's share price today is $700 billion. So it will drop from $700 billion to $100 billion. $100
billion. Gentlemen, silence.
Now, that's an 85% decrease. That means if you invested into Tesla right now today, the worst case scenario, which is also quite realistic and quite likely, is you would lose 85% of your money. Now, I'm not trying to alarm anyone. I am an investor in Tesla. I do understand the risk, but it all depends on what price you invested into Tesla stock. If you got in there at a really good cost basis, this risk is actually minimal. If you got in when Tesla's market cap was $100 billion, then you've actually got very minimal risk on your worst case, and the upside risk might be a 2 to 3x from this point. But as you can see from the numbers I've used, these are quite realistic numbers. Price to earnings ratio 25, 25% growth rate for the next 5 years, which is fantastic for a company of this size. For example, Amazon's growth rate over the past 10 years has been around 27%. Facebook's growth rate over the past 5 years has been around 20% also, which are fantastic growth rates, but they're trading at nowhere near the multiple that Tesla is trading. But for all the Tesla bulls out there, let's look at the best case scenario. Tesla gets full autonomy. They grow at a 60% growth rate over the next 5 years. And from 5 to 10 years, they carry on growing at 45% growth rate. Their price to earnings multiple is around 90. And from that point, from the best case scenario, Tesla's market cap could reach $3.2 trillion. So that's your best case scenario right there, $3.2 trillion. So from the point we're at today, that's a 4x. But what you've got to do is take into account the likelihood and the risk associated with that 4x. The best case here is a 4x. The worst case here, we lose 85% of our money if we invested today, and the average case is a double. What's the probability of the average case for Tesla stock? There it continues on the same track it's going right now. I've given that a 50% probability. Now, this is just my estimate. You feel free to use your own estimates if you download the spreadsheet in the VIP group. So with these scenarios, the fair value of the company using this valuation model, which I've created, is $1.2 trillion. So that's saying in 10 years' time, Tesla can reach $1.2 trillion, which is basically a double. This will give a value per share of around $1,110 per share. So that basically says, the average value for Tesla stock is $1,110 per share. Now, that's not to say the stock couldn't increase to that amount in the next couple of weeks. Easily it could, but that would be dependent upon the multiple for the company, the price to earnings multiple of the company, the optimism on the stock, and not the actual fundamental growth of the business during that short period of time, which is what we're seeing right now. So looking at the stock right now, we can actually see that it's actually priced for perfection. So it's at the best case. People are expecting full autonomy. People are expecting Tesla Powerwalls, Tesla Solar Roofs to be everywhere. People are expecting Tesla to be a market leader and continue growing at 60% per year. When people are expecting lots from a company, that optimism is baked into the share price, and that basically adds a greater risk to that investment. So really, it's all down to your personal preference. The average case is you get a double on your investment, but you're risking a loss of 85% if you invested in Tesla today. The best case scenario, you could get a 3 to 4x on your investment, but remember, you're risking 85 to 90% loss on that sum. But I'd love to hear your thoughts, so please do comment below. Which scenario do you think is most likely for Tesla? Best case, worst case, or average case? And if you're new around here and you still haven't subscribed yet, what are you waiting for? Go ahead and hit that subscribe button. Turn that notification bell on. If you want to take things a step further, hit that first link in the description below to be taken to the Patreon page, where you can find out more about the VIP membership group, where you can gain access to exactly when I'm buying and selling stocks, exactly which stocks I'm buying, and gain access to my entire investment portfolio. The spreadsheet will also be in the VIP group for all members to download and use as they see fit, and test out different numbers for various companies to find out a company's true value. With that being said, I hope you guys have a tremendous day, and I'll see you in my next video. Invest safe.